Hey, good afternoon, everyone. This is Hector Aguilar and Ben, your agent with Aguilar Realty Group here at EXP. And we want to thank you once again for joining us this week with our topic of the week. And, this week, Ben approached me with the question because he had a client that asked him a couple questions. Ben, what was your client's question specifically?
So my client's question was that they're in forbearance right now,
Okay.
and they're just trying to see how they can avoid foreclosure.
That's a very, hot question right now, with
Yeah.
many people being in forbearance due to COVID. And also having the opportunity to be in forbearance because of the CARES Act, many homeowners might be facing the undaunting task of a foreclosure, right? Um, and that's why we came up with today's topic of, tips on how to save your home from foreclosure. Um, what is foreclosure and how does that happen? What is the process, right? So typically, someone who is in risk of being foreclosed on is the following way. Typically, what they do is they'll miss three payments, on their mortgage, and then the mortgage banker or the lien holder will file what's called a notice of default, letting the public know that this particular homeowner is now they're starting the foreclosure process. It doesn't necessarily mean
Right.
that the seller's on the market to sell, or necessarily mean that they're going to foreclose just yet. But
Okay.
what happens is after those initial 3 months and the notice of default is filed, if they miss another 3 months, then the lien holder will file what's called a notice of trustee sale, right? And when that
Gotcha.
notice of trustee sale is filed, it typically will give you 21 to 25 days of a date where they'll have an actual court auction sale. And what
Hmm.
happens is at this court auction, it happens either at the steps of the court, and it could be the San Bernardino court, it could be Norwalk, it could be Riverside, it could be any number of places.
Hmm.
When the auction is held, there's typically investors that are there bidding on the properties. And if an investor is the winning bidder, typically what will happen is the lien holder will deed the property to that particular investor. The investor takes possession, and then the current homeowner has a short period of time to vacate the property, right? In
Correct.
the event that the investor isn't successful in maybe making an offer or gaining that particular property, and the bank actually takes it back, it then becomes what's called an REO, or what's called a real estate owned. And then at that point, it becomes an actual bank foreclosure. So that's the typical
Hmm.
process of a foreclosure. And what we want to go over is the six options that we have to avoid foreclosure, right? And there's truly only six
Yeah.
options. The first option I would recommend to avoid foreclosure is forbearance, going into forbearance. And what is a forbearance? A forbearance is a loan deferment that allows you to temporarily halt making payments on your loan, and your mortgage company has to approve it. In this particular case with COVID, there was a CARES Act that came out, and all you had to do was prove that because of COVID that you had a financial hardship, and your mortgage bank would have to approve your forbearance, right? So that's what a forbearance is. Now, most people don't know that when the forbearance is done, typically what happens is you have to repay those payments. And in
Yeah.
most cases, right, Ben, in most cases, what happens is you have to repay those payments all in a lump sum. So if you're in a
Hmm.
forbearance for 6 months and your forbearance ends month seven, it's you're not going to restart making your payment on month seven. What you have to do is you have to accumulate 6 months you missed, and then on month
Yeah.
seven make your 6 months payments and your month seven payments. So that could prove challenging to many people, just because they may not have the funds, or maybe they use their savings to live for a while since they weren't employed, or they had issues with COVID. Many reasons why they couldn't have the money, but in most cases it has to be paid in one lump sum. And if you can't do that, then the next step or the next tip on how to avoid foreclosure would be a loan modification. And what is a loan modification? It's just what it implies. It's when a mortgage company will take your loan, and you have to go through an application process. You have to prove your income, your credit. You have to do various amounts of things to show the bank that you can afford your current monthly payment, right? And
Yeah.
if they do approve it, typically what happens is they might modify like your loan term. So let's say if you're in a 30-year loan, they might make it a 40-year loan. If you're in an interest rate that's 4 or 5%, they might lower it to maybe 2 or 3%. And we've
Yeah.
seen those. We saw those in the last adjustment in 2008, where many loan modifications were doing, they were giving 2% interest for a short period of time. Now, here's the other thing with loan modification is that typically it could be 3, 5, 7 years, maybe 10 years of modification. And then at that point, it'll revert back to your original terms. So, loan modification is a great option to avoid foreclosure. You just got to be mindful of some of those terms and make sure that you understand what you're agreeing to with your bank. But a great way to avoid foreclosure. Okay. That moves us on to our third option, right? To avoid foreclosure is reinstatement. And what does that imply, Ben? Reinstatement. What does that mean to you?
Just restarting, restoring something, right? So,
correct. So in the mortgage industry and the real estate industry, reinstatement is pretty much kind of bringing your loan current and starting again with the normal terms of your loan. So you're reinstating your loan that you currently have. And a lot of people have a little bit difficult time doing that because it does entail not only paying the mortgage payments that you missed, but if you're in the foreclosure process, typically there's attorney fees, there's processing fees, there's late fees, unpaid interest, additional interest charges. So it could be a daunting task. But if a homeowner or a set of homeowners have the capacity to do it, that's one way to avoid foreclosure, is to reinstate their loan, bring their loan current, and pay all the fees. So that's the third option that they have to avoid foreclosure. That brings us to our fourth option. And as most people are aware of, bankruptcy is certainly an option, right? There's a couple of chapters, Chapter 7, which is the liquidation of debt, and Chapter 13, which is the reorganization of debt. And typically, if you want to save your property, you can do either, where you can liquidate your bankruptcy through Chapter 7 and be able to get rid of all your debt, and maybe with the court's approval is just keep your mortgage. And by eliminating all your other debt, then you would be able to start fresh with your mortgage loan and continue making those payments. Under Chapter 13 reorganization, it's just that you're taking all your debt, the court is managing your debt, you go into typically a smaller, more manageable payment to make all your debt payments, including your mortgage, and that typically will last 3 to 5 years. And when you're done with your Chapter 13, which typically is maybe 3 to 5 years, you might be able to refinance your loan to kind of bring it current, or maybe change the terms, something favorable to you, or you might be able to just kind of continue going with your current mortgage that you currently have, and stay in good standing and not not lose your property to foreclosure. Now, a couple of questions do come up with bankruptcy, right? Like, how soon after can I buy or refinance? Well, it just depends on what type of loan program you use. There's an FHA loan, which typically FHA now with loan guidelines that have changed, you might be able to refinance or purchase a home with after 3 years of doing a Chapter 7 or Chapter 13. We're not mortgage bankers, but certainly you can ask a professional mortgage banker about those terms. And the same thing with Chapter 13. It is my understanding that if you're in a Chapter 13 and you're 12 months into the Chapter 13, that there are some lenders, depending on whether it's conventional or FHA, that you can go ahead and refinance that debt, that mortgage debt, with the court's approval after completing at least 12 months of that Chapter 13 commitment. So you're basically establishing your mortgage payment again for another 12 months. So there are some mortgage bankers that will allow you to refinance just straight out of a Chapter 13 just after 12 months. So that's another option for you to avoid a bankruptcy. Obviously, it comes with a heavy cost. It's going to be on your credit, right? So that could be a negative impact. But guess what? You might be able to save your home. Okay. The next option, which is, in my opinion, one of the best options, is either doing an equity sale or a short sale, right? And what is an equity sale, Ben?
An equity sale is when you go and do a traditional sale in the market like we have now.
Correct.
A seller wants to sell their home, and they're able to receive any proceeds left after all the fees, all the dues, and any loan balance that are paid off. So
fantastic. That's absolutely right, Ben. You hit it right on the head. It's a traditional sale where, let's just say you have some equity in your home, and let's say, as an example, your home is worth 700 and you own 500. Well, you're able to sell it through an agent like such as ours, or any agency that you prefer, you want to interview, that you feel is going to help you sell your home. and you do a traditional sale. And after all the expenses are paid, escrow, title, commissions, selling fees, any late fees, penalties, back payments, anything of that sort is completely paid off. And whatever is left over, obviously you will get those proceeds in your pocket that will help you kind of reestablish yourself financially and be able to kind of move forward with your life, right?
Yeah.
The other option is a short sale, and a short sale is the exact opposite. So a short sale is typically when the mortgage balance on your home is much higher than the current value of your property. For example, let's just say you owe the mortgage company $700,000, and after you do some research, you find that your home is worth $600,000, right? You're
Yeah.
behind. You're behind on your mortgage. You're behind on your payments. You don't want to file bankruptcy, and you don't want to do a foreclosure. So a short sale is an actual awesome option. And basically, what happens is you have to go through an approval process with your mortgage lender or your bank to allow you to do a short sale. And what they do is basically the bank or the mortgage bank will approve the commissions, the closing cost, anything associated with the sale of the property. And what they'll do at closing is they will forgive typically whatever balance is remaining. So if your loan balance was 700, and you sold for 600, that $100,000 plus closing cost are forgiven, right?
Which is
There
nice.
are some kind of regulations that go with that. Sometimes you might receive a 1099 for that difference. So if you're short $120,000, the mortgage bank may issue you a 1099 where you would have to pay income tax on that. But again, that's something that you should discuss with your tax preparer. And those are two different options. You can either equity sell or you can short sell to avoid foreclosure.
Quick,
Right?
quick, quick, quick
Yeah,
question.
go ahead, man.
So is that a tax write-off for the homeowner if that were to happen in a short sale?
It is
If
not a tax write-off.
as a
Typically,
1099?
it's a tax implication, right? When someone receives a
Oh,
1099, they're receiving income, right? And when
oh,
we went through the short sale or our real estate recession back in 2008 through 2010, we saw hundreds of short sales. We were seeing, hundreds of homeowners getting rid of their property because they owed more on it than it was worth,
right.
and they had some financial challenges and they couldn't make their mortgage payments, or they couldn't afford to keep the home, they got laid off, etc., or they had a medical event, or they had a death in the family, something that impacted their ability to repay their mortgage. And typically what happens is the banks were sending out 1099s. Now, again, I'm not a tax
Um,
professional, but your tax professional could probably guide you to let you know whether or not you would have to pay income tax on that loss or not. But yeah, it would be like an income gain typically, man.
got it.
Great question. That brings us to our last and final option um, to avoid foreclosure, and that's deed in lieu. And what does that mean? It's basically a deed in lieu of foreclosure. And typically, what happens is you negotiate with your bank. It's almost like you're surrendering to the bank, saying, "Hey, you know what? There's not much I can do. I don't have the money to reinstate. I don't want to file bankruptcy because I want to protect my credit, but I really don't want this foreclosure to be reflected on my credit either. So I'm willing to deed the property over to you, lender, mortgage banker, and I'm willing to go through that process." So, you know, your mortgage banker will simply send you a packet of information that you need to fill out and complete. You get a document notarized, saying that, hey, I'm transferring the property back to my bank or my mortgage holder, and then typically the mortgage holder or the bank will give you a period of maybe 30 to 45 days to vacate the property, at which point, when that time is up, you're going to go to the mortgage bank and say, here are your keys. Thank you, Mr. Bank. And the property is no longer yours, right? Now,
Right.
in the situation of a deed in lieu, if you have equity in the property, you may lose it, right? So if you have
Yeah.
equity in the property, or if you're uncertain that you have equity in the property, at least discuss it with the real estate professional. Take a look at what the homes around your neighborhood are selling for. See if it's worth your while to sell and maybe get a little bit of money from the sale versus no money. You know,
Right.
and typically, to avoid foreclosure, those are your six options that you have. Um, with forbearance kind of coming to an end here around the corner here shortly, and we keep on getting extensions for of course, like rental moratoriums and other things. It's hard to
Yeah.
predict what the government's going to do, but if you're truly in a situation where you can't afford your mortgage and you can't see yourself reinstating the loan or doing a loan modification and maybe they didn't approve you, then an equity sale or a short sale is probably the best solution
Yes.
for you to avoid foreclosure. And we'd be happy to help. Reach out to us. Let us know if you're in that situation. Of course, your consultation will be private, as all consultations are, and we look forward to maybe guiding you through avoiding foreclosure and protecting yourself and your credit and maybe your equity. So we really appreciate you joining us today. It's always a pleasure to bring new topics to you guys every week. Ben, thank you for bringing that topic to us for this week, and I look forward to bringing a new topic to our viewers. And speaking of viewers, if you enjoy our content, please, we ask you to subscribe to our YouTube. Smash that like button. If you find some value in this video and you want to share it with someone who's in need, please do so. Click the share button, forward it over. Once again, I'm Hector Aguilar. That's Ben, your agent. We're with Aguilar Realty Group here at eXp Realty, and we thank you for spending some time with us this week. Have a great week, everyone. Take care.
Bye, everyone.